Okay, so good morning. I think we should start. It's time. So today's special lecture is by Shubhajit বিশ্বাস, who is an alumni of ISI Kolkata. He completed his MTech in QR in 2019 and is currently working with JP Morgan Chase. And he has done quite a bit of work following up on his dissertation on mathematical finance. And today he will talk about the swap contract, in particular variance and credit default swaps. So Shubhajit, over to you. Unfortunately, we cannot see Shubhajit because his camera is not working, but you can see the screen and you can hear his voice. So let's get started.
Thank you, sir. Hi, my name is Shubhajit. So, thanks to Digantu sir for providing me this opportunity to take a class of yours. Today I am going to speak about swaps. So, any idea what is swap? Anyone? Okay. So swap is basically a derivative instrument which is used for hedging market risk. So, so for example, there are two parties, A and B. A, so the swap will be between A and B such that there will be a continuous cash flow between A and B, and there shouldn't be a position where A is facing a loss or B is facing a loss. So it is basically a mutual agreement between the two parties so that they can hedge the risk among themselves. So as you can see from the definition, swaps are the derivative instruments that represents an agreement between two parties to exchange a series of cash flows over a specific period of time. So the reasons which a swap exists between two parties is because of the investment objectives, or there may be a alternative cash flow stream which they want so that some of the party will be benefited at some point of time. And the third one is to mitigate risk or hedge risk when there is a floating rate of loan repayment. So what is derivative? So a derivative is a contract that derives its value from the underlying asset. So the asset can be anything. It can be a stock, it can be a agriculture commodity, it can be a oil price, anything can be an asset on which a derivative contract is made. Today there are n number of swaps which exist in the market, but the most common ones which I'm going to discuss here is the interest swaps, variance swaps, and credit default swaps. So starting with the interest swap. So interest swap is a forward contract in which one stream of future interest payment is exchanged for another based on a specified principal amount. Let's take an example. Consider A and B. So A, so A and B signed a swap for 3 years on a notional principal amount, and let's the fixed interest rate is 8%. Okay. So here it is mentioned that notional principal amount. It means that A and B is not going to exchange the principal amount, but the interest on the principal amount. So here A gives B 8% of 100 for let's assume that the notional principal amount is 100 million, and A gives B 8% of 100 million in year 1, year 2, and year 3. So since A is giving the amount to B in year 1, year 2, year 3, so B should also return that amount, and B decided that it will return the amount with an interest rate which is LIBOR plus 1. So any idea what is LIBOR? Anyone? Okay. So LIBOR is basically a floating interest rate which is basically followed in the London exchange market. So LIBOR can fluctuate between 1% to 10%, something like that. It can be any interest rate. So when B is, so for example, consider year 1, if the LIBOR is 2%. So in the example I've taken, LIBOR in the first year 8%. So the total interest which B should return is 9 million, right? And so A is giving 8 million to B, but B is giving 9 million to A. Similarly, in the second year, consider the LIBOR rate should be 5%. Then actual interest rate which B should be giving to A will be 6%. So here in the year two, A is getting loss. In year one, A or ha, A is having a profit. In year two, A is having a loss. Similarly, in year three, the same thing. For example, the LIBOR is 7%. So the interest rate which B will provide to A is 8 million. So in year three, there will be no loss for A and B. So basically, we can see that for each year, there might be a loss for A, there might be a loss for B, and it depends entirely on the floating interest rate. Now, this interest rate swap can be actually used in the banks. So, for example, consider SBI. A bank has two type of things: one asset, one liability. So, in liability, for example, when a customer uh, is doing a fixed deposit, so that becomes a liability for the bank. And when the bank is giving a loan to a customer, then it becomes its assets. Because when the bank is giving a loan to a customer, it is expecting that, for example, it will get a 9% of interest every year. But it might happen that the fixed deposit, which in terms of the liability, the bank is supposed to pay, for example, in year one it might pay 2%, in year three it might pay 4%, in some other year it might pay 1%. So if we consider a term for 3 years, so it might possible that in the first year bank is paying as a liability 4%, in year two it is paying 6%, and year three it is paying 5%. But in the other side, from the asset it is getting a 9% every year. So it might happen that the floating rate goes up and the bank has to pay more money as a liability, then there will be a shortage of cash for the bank. And for a standard government bank, these things are being regulated. Means it cannot act like an investment bank says that. SBI cannot act like an investment bank and say that, okay, I don't have money, I can't pay it now. So to avoid this risk, so it will go to it will exchange a swap with some other third counterparty. So the here the bank will take the position of the person A, which we have decided, which we have shown in the example before, and bank B and a customer B will be there with whom the bank will exchange a swap. Now, for example, yeah. So for example, with the swap, in the swap, it will it will make interest rate swap with the counterparty, for example, with a 9% interest rate. So even though if it is hedged, so in this way it will hedge with the counterparty B, so that whatever will be the scenario, the bank will get a fixed amount of money in its asset in terms of liability and asset. Means in terms fixed amount of money in terms of liability and asset. So is it making sense?
Can you
Is-
repeat this again? This
Okay.
part.
Yeah. So for example, consider a bank. So it has an asset and a liability condition. For example, in asset, it's a fixed interest which is getting from the customer, and in liability, it is paying a floating interest. Now, this might vary in every year, but a bank should have a particular amount in its credit, means in its balance. It can't fluctuate here and there because then it's a government regularized bank. So the bank will go in a swap with a counterparty B with the floating interest rate, so that it will maintain a fixed value of interest which is getting, which it will keep in its balance. let me tell it by example. Let me write it down. For example, year one, the liability is 4%, and the asset is 9%. Year two, it is 15%, and the asset remains 9%. So what the bank will do, and it is B, so it will exchange a swap. In the swap, it will say that, okay, I will give you a floating interest, for example, of this LIBOR, okay, to B. And in return, B decided that it will give a interest rate of 10%, right? Now what happened? In year one, if it is 4% floating interest rate, bank will pay 4%, but in return from B, it will get 10%. It is maintaining a balance of 1%, the bank, right? Because it has hedged its floating rate in a swap with B. Similarly, in the second year also, it will get a fixed interest of 1% because it has again hedged the floating rate interest with the counterparty B with the help of a swap. So in this way, bank will maintain a fixed balance of 1% every year. This is how interest rate swap is applicable in bank. So does it make sense now?
Yes, yes.
Okay. So similarly, a bond investor will also take the help of the floating interest swap in the market to hedge its risk from the market movement. So interest rate swap is very much useful in terms of banks and the bond investor. So anyone know what is bond investor? Any idea? Do anyone know what is bond?
Well,
Okay.
hopefully people at least remember what is a bond. That is strange.
What is a government bond? Means, for example, uh, okay, bond is basically a cash flow. For example, there is a party A, there's a customer A who is buying a government bond from the government. So in this case, A will give, for example, 10, for example, some amount of money to buy the bond. In return, each year the bond will pay some coupon. For example, if it is a 10-year bond, then in each 10 year, the bond will pay back a coupon to the customer. And at the end of the 10th year, it will return the whole amount. So bond is basically used by the government to generate revenue for the government. And it's a type of investment by the customer. Okay. Mm, let me clear it. Now, going to the next slide. Why can't I go down? Yeah. So, this is an example of interest rate swap. So now we are going to price means what, how we are going to determine that what interest rate should the swap be priced. Means, for example, in the previous case when we said that the bank will go in a swap with the B at 9-10% interest rate. How that 10% is defined, means how we are calculating the 10%. For this, actually, we need to understand two things. So we can assume that a bond is basically a combination of a floating coupon rate bond and a fixed coupon rate bond. If you consider the first example between A and B, so A is giving a fixed coupon bond to B, and in return, B was giving a floating coupon return bond to A. So if we consider the whole process, that is the swap actually. So now for the first condition which we take into account is that on every reset date, a floating coupon should reprice to par. So what is the meaning of this sentence? So, for example, consider a timeline of 4 years. Okay. So in each year, the floating interest rate is different. So we at least know that in, for example, we are at T3 today, and we know that at T4 will be the end of the bond. Okay. So T4, the amount of value the person, for example, me is getting is rupees 1000, the bond value, and the coupon rate. And the coupon rate will be 5% of 1000. Since I am at today at T3, I know that at T4, the interest rate which will be applicable will be 5%, because today's floating rate will be used for calculating the T4 coupon rate. So the total amount which I am getting, I know I will be getting at T is equal to 4 is 1050. And if we discount it to T is equal to 3, so it will be 1050 divided by 1.05. So it will be 1000. So in this way, consider at T is equal to 2. And what happens at T is equal to 2? Similar thing, we don't know at T is equal to 4 what will be the coupon rate. So we cannot discount, okay? But we know at T is equal to 3 from a previous calculation that at T is equal to 3, the price of the bond which will be at which it will be traded is 1000, because we have done it from the previous step only. And assume a hypothetical situation. So we know at T is equal to 2, it was 8%. So similarly, at T is equal to 3, the coupon rate which I will be receiving is rupees 80. So the total amount which it should be is 1080. If the bond is was for 3 years, then again, if you discount it back to T is equal to 2, it will be 1080 divided by 1.08. It will be again 1000. So like this, we can say that at every reset value, means at every time value T is equal to 4, T is equal to 3, T is equal to 2, the bond will trade at rupees 1000 only. So that is the thing which is called that on every reset date, a floating coupon bond should reprice to par. Here the par value is rupees 1000. So this is the first condition which we are going to take while pricing the interest swap. The next thing we should take is that the swap value at time T is equal to 0 is equal to 0, because if there is initially the swap value is not 0, then there will be arbitrage existing, because at T is equal to 0, the value of fixed coupon should be the value of floating coupon bond while when we are pricing it, but in reality it might not happen. And the next thing is that I've already told that swap is basically a combination of one fixed coupon bond and one other floating coupon bond. So now we should go how we are going to do the pricing. Okay. So for example, consider now assume two party X and Y. X is offering a fixed coupon bond to Y, and in return, Y should be offering a floating coupon bond to X. For X, he is actually going short. Short means he's selling the bond. And for Y, he will be long because he is buying the bond. Okay. And so he will be long on the floating coupon bond. If we show it by the diagram, X is giving a fixed coupon bond to Y, and Y is giving a floating coupon bond to X. And we have considered the market value of the bond as rupees 1000. So X will ask Y, I've written in the slide that X will ask Y, what coupon should I pay in return to Y? Here the coupon means I'm talking about the interest. Since it is a swap, I'm talking about the coupon means the interest rate, which we are going to decide on the coupon. So Y said that at the time of maturity, I should get the bond market value at par, means I should get my 1000 rupees back. So here we are taking an example. So we are considering, for example, let the spot rate for 4 years. The year one is R1, R2, R3, R4. So the spot rate are basically the floating rates. Okay. Now assume T is equal to 4. So at T is equal to 4, I am getting a coupon C and the 1000 rupees 1000. Yeah. So if I discount it to the present value, it will be 1000 divided by, as you can see from the calculation, 1000 divided by 1 plus r to the power 4 plus this thing will give my discounted, will give me the present value now when we are discounting from t is equal to 4. Similarly, from t is equal to 3, we are getting this value, and this value for t is equal to 1. So these are the discounted values at present time for the entire cash flows at T1, T2, T3, T4. And since our assumption is that it should be there at T is equal to 0, the T, since according to this condition at T is equal to 0, the value of the fixed coupon bond should be equal to the value of the floating coupon bond. So we are equating it to 1000. Now solving the equation, and for our simplicity, we are saying that 1 by r1 is equal to z1, 1 by r1 plus r2 whole square is equal to z2. Like this, we are assuming the discounting factors as z1, z2, z3, z4. And after doing that, we are calculating c. So this is the value of the interest rate on which the swap will be priced. So this is the only thing we are discussing interest rate swap, how to price the swap. So in this way, the bank or any customer will go into an agreement of a swap based on these factors. Is it clear?
Yes, sir.
Okay, cool. Next, we will be discussing about variance swaps. So in interest swap, we are basically dealing with the interest, and in variance swap, will be dealing with the variance of an asset. Basically, the asset will be option. So what happens? It is also OTC derivative, financial derivative, and so there are two things in variance option. In variance swap. So one leg of the swap will pay an amount based upon the realized variance of the price changes of the underlying product. For example, consider option. Okay, so option, the underlying price can change. Okay, so this can, so let me take an example, then it will be better. Yeah, for example, there are two-person A and B, so they have entered into a variance swap agreement, and A is saying to B that I will pay an implied variance of 6.1 16% volatility. So what will B pay to A? So this is the thing which we are dealing with. So in variance swap, the price changes will be a daily log return based upon the most commonly used closing price. So in options, we generally consider the price, return of the spot price on a daily basis as the log of spot return. So S2 by S1 will give me the R1, S3 by S2 will give me the R2. Like this, we calculate the everyday return on a log scale. The other leg of the swap will pay a fixed amount, which is the strike quoted at the deal's inception. So any idea what is option? Anyone? If you have the idea of option, then it will be easy to understand actually.
Option is known.
Okay. I think they are on a sleeping mode, maybe. Okay, so option is basically uh, an instrument in which means that gives the holder the right but not the obligation to buy or sell a underlying asset. That is the option. So the variance swap is basically, if you think about option, it is basically on the similar line. Here it is just taking the realized variance as a feature of the swap. So when there will be a change in the variance, or because there will be obviously a change in the prices of the spot price every day of this option. So it might happen that the spot price, because of this, for example, because of this COVID situation, the spot price have fluctuated very much in options. So to hedge that risk, we are taking the variance, realized variance of that option to make a variance swap. So the net payoff to the counterparties will be the difference between these two and will be settled in cash at the expiration of the deal. Though in between some cash payments will likely be made along the way to the other counterparty. So mathematically, the payoff can be written as notional variance into sigma realized minus variance strike. So variance strike is the variance which was decided during the swap agreement. Realized variance is the variance which we will be calculating. For example, if the variance swap is for 5 months, we will be calculating throughout the 5 months the realized variance. And NVAR is basically the notional variance, and which is calculated as the Vega notional for volatility swap. And what is Vega? Vega is basically the sensitivity of the option on means on the volatility, means del S by del sigma is the Vega. So as you can see in the definition, sigma realized is given. So it will be summation of Ri square into A by N. Generally, we consider the N as 252 for 1 year. And as I mentioned, Ri is the log return of the spot prices. Next, going to the next slide. A is the annualization factor. Uh, okay, A is the annualization factor. N is the number of days which we are taking into account. Means the period of the swap. So how we are going to price a variance swap? So the derivation is actually not required here. So it uses the concept of stochastic differential equation to variance the swap. So we are not going to that. We are just trying to get the final formula of the pricing of variance swap. So the most important thing is that in variance swap, we are creating a mimic of the portfolio, which which consists of put and calls. And and for any swap, as we know that at the initial point of time, the prices will be same, so that there is no arbitrage present. So the fair market value of a variance swap must equal the price of the replicating portfolios of put and calls.
Shubhajit, there are some comments in the chat. Can you check?
Okay, let me check chat. Okay. Why the PF contains the factor n val? Why not simply sigma n minus k? Okay. So this is a notional amount. So the swap should be based on some notional amount, right? It can't be only the difference between the two variants. Though it should have a notional amount in it, for which we are multiplying with the n var. So there will be obviously a notional amount present between the two parties on which the swap agreement will be done. Is it clear, Subhrojit?
Yes, sir. Thank you.
Subhrajyoti has a sore throat, so he has difficulty speaking today.
Okay, fine, no issues. So every swap is based on some notional amount. So here the notional amount is the variance notional. So in interest also, in interest swap also, we have a notional amount in that. On notional amount only, we are doing all types of interest or variance, everything. So there is a concept called volatility smile. So a volatility smile is basically at the at the implied vol patterns which arise when we are pricing an option. And now comes what is implied vol. So implied vol is the vol when we put in the Black-Scholes model, it will provide me the theoretical market price of that option. So basically implied vol is a futuristic characterization of the volatility surface. And an implied, so a volatility smile is actually dependent on the means if we see the implied vol, so implied vol is actually based on the strikes and the maturity. So it's a surface. In the x-axis you can assume that there are strikes, in the y-axis you can assume that there are tenors, means the maturities. So this will give me a volatility surface, that is the implied vol surface, and from the implied vol surface we can get the volatility smile. Now we are discussing this because when we are trying to calculate, basically when we're trying to price the variance swap, we are using the strikes of the volatility smile, K1 to Kn, for example, for a particular tenor. And we are going to split that between the out of the money put and calls. So since we are saying that we are going to price the variance swap based on a portfolio of put and calls, so we are going to split it between out of the money put and calls. We are considering the out of the money as a quick proxy for the fair value of the variance swap. That is the reason we are doing a split. And just you need to remember this formula. So is the var swap is equal to 2 by t. You can see from the screen only, where t is the maturity, means the tenor of that swap, is the price of the European call or call strike at K, means at what strike the value of the put and call will be. And initially K naught is always 0 we are considering. So the strikes and option prices are expressed in percentage of the forward price.
Shubhajit, there is another question in
Yeah,
the
yeah.
chat from Abhinandan.
Shouldn't the pricing also involve the money that the people already have and the number of sources ingredient? If my dear, shouldn't the price also involve the money that the people involved in the contract already have? Yes. So money, see, swap is basically actually not involving the money. It is involving the changes in the market structure. So if you consider the bank example, no, for example, let us consider variance swap only. We, for example, consider a portfolio considering a portfolio having some asset, agriculture asset, 1 to 3. So we can find out the variance of that asset. So from the variance of the asset, if the prices are fluctuating of the option of that asset, then what will happen? We are not, we are actually trying to hedge the risk in terms of the return which we are getting. Means, uh, I think, are you understanding? Means, for example, here we are not dealing with the money, we are dealing with the interest which we are supposed to get from the money. Because hello, hello, Abhinandan, you are getting, means can you switch on your mic?
Abhinandan, can you respond now?
Means you can switch on your mic and ask the question. Means exactly I'm not getting, means money means what type of money you are saying here?
Yeah, so my neighborhood was noisy right now, so I tried not to.
No, it's okay. You can tell.
Okay, now it has quietened down for a little bit, so I can try to like frame the question. So what I was asking that is that we are trying to do this so that we can safeguard ourselves
Risk.
against the volatility in the open market, right?
Yeah.
the volatility so I am entering into a contract with someone else,
Mhm.
but his financial status is also not independent of that volatility. So if he's not accountable, if he's not accountable to on doing his part of the contract, then the risk is not effectively hedged.
Yeah, so for example, here A, B. So A and B are entering in the swap of volatility, right? Now what will happen? B can also go into a third with a third counterparty C, and he also can enter into a swap so that he knows that he will enter into such a swap that he can maintain the things between A also. So it is a chain process. It's not like that it's only two party. Means if here you should see in the macro level actually, it's just not only one part, only two people who are entering into the swap. There are n number of people who are entering into the swap. You're getting, means A, B, C, D, like this. There will be a lot of people.
I was asking this when I am considering the pricing of that contract,
uh,
then shouldn't I also consider the chances that either party would be defaulting on that?
So that is the reason. It's not that I'm only going into the swap into into agreement with that party only. I will also hedge my thing with some other counterparty also, so that in case that party defaults, I can get something from that party also. You're getting me?
Yeah, I understand your point. So essentially trying to say that you put your eggs into different baskets and hope for the best. But
Yes, yes.
what I'm trying to emphasize is that I mean, you still need to determine the price of any contract, right? So you are just hoping that everyone would be doing good things by separating out their potentials
Yeah.
and
So basically, we are taking into account also of the historical. So when we are pricing a swap, we are taking into account means the walls of. So the spot returns we are not getting, right. We are doing a historical analysis of the data of that basket and trying to assume that it might be the price of the swap, right, from here. It's just a historical thing which we are from the historical data we are calculating the swap and saying that in future it might happen in this way, because implied vol, as I've said, the volatility smile, the implied vol is a surface in which we are considering a grid of strikes and tenors. So we are assuming that if the strikes are there, what can be the implied vol which we can obtain. Means it is a futuristic prediction type of a thing, and which we are getting it right from the historical data. So we have that knowledge that okay, means if we are entering into a contract of volatility swap, we are supposed to get, means we are supposed to do such type of hedging so that we can incur less amount of loss. It's not that we are getting a zero loss. We might incur a loss, but it's not just that we are getting, means we are just trying to hedge the risk. That's it. It might end up in a loss. It might end up in a loss for me.
okay.
Means it's not a guaranteed thing that ओके चलो मैं हेज कर लिया तो मेरे को कुछ नहीं होगा, मैं तो प्रॉफिट में ही रहूंगा, मेरे को प्रॉब्लम नहीं होगा. इट्स नॉट लाइक दैट. इफ यू सी द formula in the payoff, actually this thing matters, right? So this sigma realized is over the time which it I will calculate. But when we are pricing it, we don't know the future sigma, we don't know the future sigma realized, right? I think it's still not clear, right?
No, what I'm saying is that I agree that the future is not known, but we still have some distribution on that, right? So shouldn't that distribution be also considered to like to find out what risk, what expected risk we have, and counter it by the price in the contract?
Mm, so that is the reason we are doing this swap, right? To counter the risk only. And the distribution which you are talking about is that Means whatever distribution you means, can you please explain me?
All the parties involved have some like have some expectation about the future, right? So
Yes,
that
yes.
what I wanted to tell was that if someone going default on
Mhm.
someone enters into this contract, but ultimately there is this possibility that they might not be able to
Paid, paid.
enter this contract.
Yes.
So, and that possibility would be dependent on the like from how rich that person is. So what are the realistic chances that he might be defaulting? So those kinds of stuff should be involved in the pricing model to ascertain what the potential risks are.
Hmm. Yeah, yeah, you are correct. Means it should be included, but that shouldn't come. It might not be possible that, so knowing, if I know, for example, party A, party B, I know that party B might default. Okay, I know that it might default. I have that idea in my mind. So as a party A, I know that if the party B doesn't default, I'm going to earn profit from this swap, whatever, by hedging risk only. Okay. But since I have that in my mind that party B might default, as a party A, if there is a default which is happening, the amount of risk is involved. As I've mentioned you, I will go into another agreement with some other party in some other swap. So it will be a predefined thing for me कि हाँ मेरे को पता है कि ये पार्टी भी डिफॉल्ट कर सकता है, so I will go into another swap with another counterparty. But for only A and B, we are not going to decide upon, when that factor won't come in determining the pricing of the swap. Ki if it defaults, then what will happen? Means that thing won't affect the pricing of the swap. The only thing which will affect the pricing of the swap is the options, the underlying options which is involved. How the prices are fluctuating throughout the time period, means how the volatility surface is changing. Is it
I
making sense?
think just to, wanted to put in a comment here. I think
Yeah.
what Abhinandan is worried about is about the risk perception of the individual investors. Is that correct, Abhinandan?
Yes.
But
Yes.
that we are not considering because we are working with the risk neutral probabilities. So we are only looking at as if all investors are risk neutral.
Even if the even if they're risk neutral, I mean if they have the common probability of risks, even in that case one might have a one person may differ in their probability of default from another person because they might be beginning with a lesser amount of money. So the risk perception, even if the martingale probability remains the same, the chances of a person defaulting might vary based on what the initial capital of that person is. So my concern was exactly there. So what Shubhita is trying to say is, I think, is that he's saying that, oh, okay, so in that case I can always go into further contracts and I do not need to worry about someone defaulting. But a pricing model inherently assuming that someone will be doing that, and so we do not counteract for that effect is, I don't think, an efficient design. But I don't know.
Okay, if it is the default that you are worried about, then the next model will answer that question.
Okay.
So these variance swaps are individual contracts, and you handle the default in aggregate because in aggregate you can use the law of large numbers. So the credit default contract, swap contract will respond to that.
No, this was what Shubhajit was saying, that with using the law of large numbers, you can be sure that not everyone will be defaulting.
Yeah,
And
so
fine.
that we will discuss in the next slide as Yono said. Yeah.
I'm fine with that, but even in that case, you need to have some pricing for each of the contracts, right? And uh, and you are just expecting that based on the law of large numbers, not everyone would be defaulting, and hence I just ignored that fact. But by the same law of large numbers, not everyone might be able to adhere to that contract as well. I mean, not all negatives would be happening by law of large numbers. Similarly, it can be possible that not all positives are happening. So how are you counteracting that effect in the through the pricing of the contract? So the pricing of the contract should take that into account as well.
Means, for example, if I know, means what are the things from which we can means default, means if it is defaulting, what are the parameters through which we can say that the person is defaulting? Means if we are taking to, if you are taking into account that thing, the default criteria in pricing the swap, what are the features we should take? Means I don't think we can take any feature from out of it.
I mean,
Means there should.
let's consider this analogy that suppose
uh,
you are suppose I'm going to a bank to take a loan for
uh,
to build a house, okay,
uh,
and then I build that house, and after 10 years I say the bank that no, I cannot pay you back, okay.
uh,
So if that is the case, and initially if the bank wanted to counteract for that risk by determining what the interest rate should be, or whether they should be giving me loan or not, I
mhm.
could go and tell them that okay, even if I do not pay back, you have many other people from whom you can retrace your loans, so you need not worry about my parameters of the contract, because you would be anyway getting the money back from others. That is not a that is not a that is not a good, not even a good, that is not a fair pricing model. The pricing model should be dependent on the parameters of the parties involved, and not what they are doing with other people.
I understand your point actually. So that is the reason, the example you have said, वहाँ पे people check for the credit rating and all before giving a loan, right? They check the credit rating, how the bank statement and everything,
Yes,
whether in past,
everything is also dependent on the fact that how much money the person right now has,
yeah,
who is being granted the loan. So
yeah,
whether
how much,
it
how
in
much,
the, in this variant in the swap contract.
yeah, but that we can't quantify, right? That thing we can't quantify that thing, right? That's a qualitative thing. We can't quantify that thing in the pricing of the swap because the swap is based on the underlying instrument. So so the credit rating of that person is not an underlying instrument, right?
Right. Yeah, because yeah, there that is the advantage, that since the banks have the upper hand, so they can determine what measure they want to use,
How?
and people can do that. So
Yeah, in terms of if assume it's not a bank, so I can do the swap based on the underlying agreement. मेरे को पता नहीं कि वो उस बंदे का क्या है, with whom I'm doing the agreement, how, whether he will default or not. For that we have, for example, consider two investment banks. So the investment banks will have their own portfolio, right? They will have the, but they won't disclose their portfolio to the other bank, right? I am having this much of portfolio. For example, what happens in dark pool, the same thing. In dark pool, what happens is that the other banks don't know what type of trading they are doing in the dark pool. So they have their own desk, own portfolio, from which if there is necessary, they have to pay their default amount. So those things we can't quantify in this pricing of the swap, because pricing of the swap is only based on the underlying asset. Uske baad, if the default, that is the reason we have something called credit default swap, or we will go into some other swap agreement. Means that is my thought. Is it clear? Means we-
I'm not entirely convinced, but I guess I would allow the class to go on. Right.
So I guess so for the time being, let us complete the discussion and then we can come back to this question. But the
but
next,
it's a good question.
yeah, yeah, definitely it's a good question.
It's a good question. ठीक है चलो. So we are So we have two questions here. Actually, these are very basic questions. Using the formula only you can calculate. So I'm not discussing these questions. It's very simple. Uh, Next, we will come to credit default swap. So in credit default swap, so this is the thing which happened in 2008 recession. So for example, there are A, B, C are the customers. Okay, let's assume not customers. There are some firms. Okay, so B1, B2, B3 are the banks. So for example, A and B enter into agreement that okay, B will give some $1 million to A, and in return A will pay 10% return. Okay, but B, so for example, the credit rating of A is not good, but since it is getting and A requires money, but the credit rating is not good, but still B1 seeing the interest which he is receiving of 10%, he enters into an agreement with it. I will give you 1 billion, and in return you give me 10%. But since there are chances that A can default, so B1 will again enter into an agreement with I1. So I1 is basically an insurance company. So for example, the insurance company is like AIG. Okay, AIG is an insurance company, and Moody's is a company which actually does this credit rating for this A, B, C, I1, I2, I3, all this. Okay, so Moody's have a very good rating for I1 that chalo, it has some AAA rating. So B1 will enter into an agreement with I1 saying that I will pay you 1% each year, and in return, if the A defaults, then you need to pay back the entire money to me. So in this way, A, B1, and I1 gets into an agreement. Okay. Now, how? So this is just three things which are involved, but in 2008 scenario, there were n number of things which were involved. So there were A, B, C, for example, the customers which were there. Excuse me. I1, I2, I3 are the insurance companies. B1, B2, B3 are the banks which provided the loan to the customers. Okay. So there will be a chain of things which will be happening. So as you see from the slide, A and B are say the customers, A and B taking loans from bank B1 and B2. A takes loan from B1 of 1 billion at 10% rate of interest, but at the same time, B1 buys a CDS. So these B1 and I1 will enter into a CDS, okay, in which I1 will be getting 1% and B1 will getting the insurance amount if A defaults. Now, similarly, for example, there is another customer B like this B2 I1. There is also an agreement. So B2 and I1 is also into a CDS. B2 and I2 is also into a CDS. Now, somehow it happens that there is a hedge fund H1. Okay. So what it will do, H1 knows that B has a chances to default. Okay. So he will buy a CDS from I2, and the CDS is actually for the customer B, and the CDS in this CDS he plans with I2 that if B defaults, then you pay me the interest amount, and if B doesn't default, I will give you 0.2% interest. So these I1, I2, I3 are the insurance companies which have a very good credit rating. So, and as I have mentioned to you, this credit rating is done by Moody's, and ABC doesn't have a good credit rating. Now, for example, if a scenario comes when actually B defaults, okay, when B defaults, then what happens? I2 has to pay a lot of amount to I1 as agreement was made of, for example, 10 billion. Similarly, since B defaults, then I2 has also have to pay money to B2. Okay. Now seeing this so much of thing, seeing I2 is paying out so much of money, Moody's decided that it will actually degrade the rating of I2 from AAA to, for example, AA or single A, something like that. Now, when this insurance company will will have its rating downgraded, then actually it will create a chain reaction among all other banks and insurance companies. So this is the thing which happened in 2008 recession, when actually the customers defaulted, and when the customers defaulted, the insurance companies has to pay the amount to banks. And since there were a huge pending for the banks, the AIG was under a severe loss. Means at that time, actually, jitna I know ki the US government has stepped in and helped out the insurance companies and the banks to pay back their loans. So this is what happens in a credit default swap, when a credit default swap fails actually. Now the thing is that we are going to see how we are going to price this credit default swap between B1 and I1. So default protection buyer here, default protection buyer is the bank B1 and default protection setter is the insurance company. Okay. Now here it is shown in the figure that the bank is going to give 90 basis points per year to insurance company. Now our task is how to decide this 90 basis point. Now let's assume that uh, for a part, so we can consider here, for example, n years for our simplicity of calculation. We can consider for 3 years default credit default swap, uh, and let the default probability is given by QT, means probability of survival is QT. Okay. And so the default probability will be 1 minus QT, and DT is the discounted rate, R is the recovery rate, means what is the chances that it will be recovered, and S is the annual premium, and D is the accrual days. So here what happens that we first calculate the present value of the accrual payment. So QT minus QTI minus 1 gives me the survival probability between two time periods. Okay. And that multiplied by the premium amount. So this premium amount S we need to find out. That multiplied by the premium amount S and the number of accrual days, we will discount it to the present value. For example, if there are 3 time periods, so I will calculate this thing for the third time period and I will discount it to the present value. For T0 to 2, I will calculate the same thing and we will discount it to the present value. Like this, we will find out the accrual payment at the initial time, because we are going to price the swap based on the initial time T0 to 0. Similarly, for the expected payment also, this is the formula, how much we can expect. The same thing, since the payment is expected, means it is basically not defaulting, it's the company is still surviving. Means in this example, when you consider the I2 and H1, so B is actually surviving, means so we are so B so I2 is expecting a payment from H1. This expecting payment is calculated with the help of this formula. And in case actually the customer B defaults, then the expected payoff will be 1 minus R into the survival probability difference into the discounting factor. So I think if we take an example, it will be better to understand. Let me take an example. For example, the probability of survival is 0.2. The probability of default is 0.2. For example, the survival will be 0.02, and it will be 0.98. Okay. I can't draw the 8. 0.98. So for the year one, and assume that the discount rate the rate of interest is at 5%. Okay. And the recovery rate is 40%. That much amount can be recovered. Means 40% of the amount can be recovered. So for the year one, for example, the party doesn't default. So the survival will be 0.98. Okay. So the expected payment will be for the year one will be 0.98 into E into minus. So if you discount, it will be E to the minus RT, right? 0.98 into E to the minus RT into the annual premium S into the number of accrual days. So accrual days will be given in the question. So this will give me the present value of the accrual payment. Sorry, this will give me the expected payment. Okay. And the accrual payment will be for the year one, it will be 0.98 into this amount. Guys, you are getting, means from the formula, actually it's actually difficult to, means, are you understanding this formula, how it is working? Anyone? Okay. So 0.02, 0.98. Okay. Now in the year two, it will be, again, the default rate will be, since it survived year one, in the year two, it will be 0.98 into 0.02. That will be my default rate. Into this. This will be my default rate for point year two, and this into another 0.98 will be a survival rate in my year two. So similarly, I will again calculate this portion for both year one, year two, and the expected payoff. If it defaults, then what will be the expected payoff? I will calculate this amount. So for this, this I will calculate for the entire 3 years and take the summation. So that will give me the present value of the expected payoff and the present value of the expected payment. Total payment is total payment is the accrual payment plus the normal payment. So if we equate both the things, we can find out the S. So this S will actually be the 90 basis points per year, which we can calculate for pricing this CDS. This calculation is actually easy calculation. So any doubt in the CDS calculation pricing?
So are these calculations clear? If there is a problem, just ask. Subhrajyoti is saying that it's clear to him.
Yeah, it's an easy calculation.
Yeah.
So I think we are done with the 3 swaps. Any questions? Anything?
Okay, so are there questions on the overall content? Any clarifications?
Yeah, anything which you guys want me to add or something, you can try.
I know Vinandan might have a question regarding the different sources of risk, but anyone else?
One little other question also. Should I go ahead and ask it, or have I pestered you enough?
Sorry, I didn't get you. Could you please repeat?
I said that I had one other little question, but
Yeah, ask me.
are you pestered enough?
No, ask me. Let me try.
Okay, so when could you go back to that graph thing where one invest where the different insurance companies were it?
Yeah, true.
Yeah.
Going.
So my question is exactly there. So the insurance companies have different in sizes, right? I
Yeah.
mean, in sizes of their budget.
Huh.
The insurance business is very susceptible to the economies of scale. So
Yes.
the large insurance companies have a lot higher upper hand because they can, like, their risks effects can cancel out.
Yeah.
So why do they insure other companies' transactions? Because if the other companies default, then it's good for them, right? Because more of the business more of the small business are driven out, and they can get a more part of the market share. Why do they do this? I mean, what's the rationale?
Okay. So the first thing is that what I understood is that you are saying that why these insurance companies go into such type of contract, right?
Yes, I am talking about the contracts between insurance companies. Why does it do that? So the smaller business, the smaller insurance company would want to do that. Why does the larger insurance company want to do that?
So see here, if we see this example, the 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 basic assumption was is that if A doesn't default, he will get a continuous amount from B1, right? Which will actually help him to grow his revenue, assets basically. And and this swap is only for 3 years, right? For example, uh, if in 3 years it doesn't default, then it's a profit for I1 as a big insurance company. This is the only way he is going to earn money basically. And a default case doesn't happen every time. So in 2008, what happened when the default happened? It started a chain reaction, and for which the government has to involve in that to bail out these insurance companies and the banks. Otherwise, if you've seen a normal economic scenario, a company won't default. So this is based on the company actually defaulting. For example, a company means I'm talking about in terms of billions. So 10% of a billion is a very huge thing. A 1% of a billion is a very huge thing, right?
So in this case, there are not two companies who are insuring each other's
No, no,
dealings.
no, no, no. Here the insurance companies are not insuring each other. It's the insurance companies are insuring with the banks and with banks only, because banks is the person, they
Right.
know they will get the money back from the bank.
That is what the source of the confusion was. Yeah.
Yes.
Okay. Get
Yeah.
that.
Yeah. So these three are the basic, means these are mostly used in the market. These three swaps. And there is another one. There is the currency exchange swap, but it is similar to the ground of interest rate swap only. The currency FX is just it just that takes into account the FX rate. That's it. Nothing else.
Okay, so any other questions? Anyone else?
So it still seems a bit wavy to me why an insurance company would like enter such a contract like for just 1%. They would give such a big, because like if a person will default, then they'll give the whole amount with interest just for the 1% that if it doesn't what you call default, then they'll get.
So
So
in the
basically, from the loan person who's taking a loan, it makes sense because he has to take the loan. The bank is mitigating its risk by going to insurance, but what the insurance is getting in return, like that seems a bit.
so if you see the example which I said, the default rate is 0.02, right? It's
Yeah.
very less. Well, it might be 0.002. Okay,
Okay.
and it is getting 1% of 10 billion. So it is getting 1 billion, right, per year. It's a huge amount. And it's not that only one company is doing an insurance with that I1. There are 4 or 5 companies who are doing the same type of insurance. And they don't need, if the company doesn't default, that will be a total gain for them, right?
Yeah, that is true. So basically, what I think is they have some kind of a like with certain high probability, like out of all insurance that they are all such serious that they are taking certain number of them won't default. Like
Yeah,
I think that should be a
yeah.
possible.
That's true. That's true. Means
Oh,
that's true. Yeah.
okay, fine.
Hmm. Any other questions?
Okay, so if there are no other questions, then I think we should thank Shubhajit for giving us this introduction to swap derivatives and how to price them. Thank you, Shubhajit.
Thank you, sir. Thank you, everyone.
And if there are further questions, you can always send emails and we will Okay, so
Thank you, everyone.
I think we will finish today's session now, and the next class is next Monday in the evening. So remember that next Monday, 14th, the class is from 7:30 p.m. That is Professor Indranil Sengupta's session on Barndorf-Nielsen-Shepard model. Okay then, so I will see you next Monday.
Thank you, sir. Thank you, everyone.